Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good afternoon. Thank you for making time today.
Good afternoon.
Well, let's start with the bond market, Mr. Yu. We'd seen yields on shorter-term treasuries rise above those of longer-term bonds, which has often signaled a recession on the way. But on Monday, the yield on the 10-year touched its highest level since 2018, and that would seem to indicate concern among investors about inflation in the nearer term. What are the implications of these moves in treasuries?
Yes, if you look at the 10-year minus 2-year government bond rate, the differential has expanded from minus 0.05% at the beginning of this month to now about 0.4%. Clearly, if that number turns to negative and continues to remain negative, within 1 year of time, most likely the global recession or the U.S. recession actually happens. Main reason for that is because when that happens, usually the loan growth rate turns to negative. Given the fact that the margin between the loan and deposits becomes zero or negative, and therefore the banks will be reluctant to lend, that causes the overall economic recession. However, as we see from the Bank of America results in first quarter, the net interest margin has expanded, and loan growth rate remains to be well above 9% growth rate. If you look at the overall banking sector as a whole, the total credit growth is around 9.2%. So that results into the net interest margin expansion, and that the net interest income grows by quite a significant amount. That means then banking sector continues to lend more, and therefore the economic recession does not come through. Clearly, the margins are probably nowadays more keen towards the 10-year government bond rate minus the 3-month government bond rate differentials, which continues to remain at around 2% territories. So therefore, we do not think that economic recession will be happening anytime soon. At least we have about 2 years period before any type of signals that the economic recession might happen in the future.
Well, it's earnings season meanwhile in the U.S., and stocks closed a little bit lower on Monday. Some exceptions like Twitter up 7.5%. Bank of America beat estimates with its earnings. What's the story in the global equity markets?
Yes, so when you look at the futures market before the market opened, it was quite a bit of down. So people were concerned about the global recession that might be coming in faster than expected because of the uncertainty remains at the commodity prices, global inflation pressures, and the Fed's tight monetary policies. But if you look at the overall market yesterday, it closed at very slightly down. In fact, market seems to be actually taking a positive indication that there might be policy improvement, and that the uncertainty about interest rate impact is already quite a bit of priced in. So we are looking at the futures market right now. The U.S. futures market seems to show a rising trend despite that U.S. government 10-year bond rate remaining at about 2.87%, which is one of the higher level that we haven't seen in a various years. So clearly, I think that people are much more focused on the earnings rather than the macro numbers and interest rate environment. And if you look at the overall earnings number, it seems to come in at quite reasonably good number. Most of the companies that are releasing the results, they're showing that bottom lines are better by about 70% plus of the companies are showing that bottom lines are better, and also more than 80% of the companies are showing that the sales numbers are much better. So clearly, we are not seeing any signals of the economic recession from the earnings numbers from the corporations. So therefore, we do think that in the future we need to watch more carefully about what happens to the overall margins and the sales growth rate and earnings number. And we think that the earnings numbers are not going to be disappointing, at least for the first quarter numbers for the time being. So therefore, we don't think that the market will be in a position for heavy correction, but rather volatilities, and then maybe gradually be able to rise again towards the second half of this year.
Well, some of that optimism seen here today in Korea as well. A strong gain today virtually across the board for the top companies by market cap. Shippers and shipbuilders outperformed today, as did chip makers. The KOSDAQ doing even better than the KOSPI, and there foreigners were net buying. Tell us about the domestic market.
Yes, as you said, the general trend seems to be quite reasonably okay. We have seen Korean won stabilizing, not much, but anyway, it remains to be around 1237.5 won to dollar. It did go down, go up to as high as 1240 before, so it seems that it's stabilizing, and because of that, we have seen foreign investors no longer net seller of the market, and also they're actually purchasing back some of the futures, and they net bought about 216 billion won worth of futures. Also, the domestic institutional investors are net buyer of Korean market by about 361 billion. Only the retail investors were taking some profits on the rise that we are seeing right now. All in all, people are concerned about the global economic recession and also concerned about the Fed rate hike, and also the Korean, the BOK have raised interest rate before, so that has resulted into a liquidity reduction. But if you look at the overall domestic consumption and the COVID-19 impact, it seems to be dwindling down. And therefore, we do think that domestic consumption should be reasonably okay going forward. On top of that, the overall export numbers remains to be quite strong, despite the cost of the goods are rising. But nevertheless, the selling price seems to be rising accordingly as well. So be able to transfer some of those cost increase to the actual selling prices. So overall, we are seeing continuous, very strong export growth numbers. So therefore, Korean market is probably in a good position to recover. On a valuation basis, at around 2,700 KOSPI level, Korean market is trading at only 10 to 11 times P multiples. And return on equity is expected to bottom out this year and then expected to rise next year. So therefore, we think that the market is no longer to be in a position to correct, but rather to show a rising trend in the future.
Got it. All right. Up against the clock today, Mr. Yu. We'll have to leave it there. Thank you, as always, for sharing your insights with us. We appreciate it.
Thank you very much.